Hey everybody, Jim Ingersoll here with the Real Estate Investor Success Podcast. I am super pumped that you're with me. Buckle up because we're going to have a great show today talking about how to find and fix broken apartment buildings. And I can't think of any other guest in the entire universe that I'd rather have this conversation with than the amazing Jerome Myers, who's also a professional engineer, another recovering engineer. I'm so sorry, guys, like myself. And anyways, he's been doing a great job buying apartments throughout North Carolina and Virginia. And let me tell you about Jerome, because he's also speaking at Dealmaker 2021. Jerome leads the Myers Development Group, which focuses on buying broken apartments and using innovative thinking and solid execution strategies to optimize the operational efficiency of that business. Think about it. When you buy apartments, there are many value add components, but the least expensive one, in my opinion, is the operational one. So we're going to dig into that. We're going to talk about how to get started buying apartments and why you want to look at it and why that makes sense given the economic sort of reset we're going through with the pandemic right now as well, because I think better opportunities are going to be coming very soon. So Jerome, welcome to the podcast today.
Jim, I'm so grateful you're having me on your show, man. I don't know what to do.
Well, you fix broken apartments. This is easy.
Yeah, I do, and it's fun. James and I have been partnered on a number of different deals in Virginia, North Carolina, and have the great fortune of meeting you through him. So just grateful.
Well, and we're both recovering engineers. We're both recovering corporate slaves. So let's go back just a little. I want to tell your story, like, where did you grow up and how did you end up kind of going into the path of all of a sudden you're a PE? That's hard to get. And then you're in corporate America and then you're out and you're an entrepreneur. Kind of take us down that path a little bit.
Yeah, so I grew up in Fayetteville, North Carolina. I'm the son of a soldier and a stay-at-home mom. So I only bring that up to let you guys know I didn't come from a lot. My dad used to jump out of airplanes for extra $200 a month so we could go out to eat, buy shoes, and some of the other luxury stuff. Left from there, went to North Carolina Agricultural and Technical State University, got a civil engineering degree. Sophomore year, I realized, hey, I don't want to be an engineer. And it was around that same time, a buddy of mine was sitting on a stoop outside of our apartment. And I was like, I pay for $395. My two roommates pay $395, and you're doing the same thing downstairs in your apartment. Then we multiplied it around the complex. The guy was making $700,000 a year, and we didn't ever see him. We never talked to him. We didn't know what he looked like. All of these things, he had figured out how to decouple his time from money. And so I knew then that, my long-term trajectory was to come back to that, but back to my upbringing, right? No attorneys, doctors, lawyers, nobody of real wealth was coming over to have dinner with us. And so it took us about 15 years to go through that. Got into corporate America, excelled, got on the high performance track, and went through a bunch of different stuff, had a ton of mentors. My claim to fame in corporate America in 2015 and 16, I built a division. And so I think it was January 13th, 2015, I started a job. I was employee number 2. By August of that year, we had about 175 employees in that division. Wow. By the end of the year, we billed about $20 million in revenue to the client. And so we went from 0 to 20 million in a year. The thing that sucked about that was I had to lay employees off at the beginning of the next year. And it was my first time being in that role. I was like, there's something wrong with this. We made 20% profit. No, 30% profit. And, there seemed to be like a disconnect between the input or the value that folks were providing and the way they got treated when we ended up in tough financial times. My reward for that $6 million in profit was a $30,000 bonus. I was like, this doesn't make sense at all, right? And so we get to the next year. I'd already promised myself, hey, we're not going to lay anybody off. And the day before Thanksgiving, we call everybody in. Hey, we're probably going to end up doing something, so don't go crazy on Black Friday. And I said, I'm dropping out. I'm out of corporate America. I'm not going to do this again. The holidays for me aren't going to be ruined every year. We're trying to figure out who's going to go with me and who's not going to go forward with me. And so I walked out and thought I was going to buy an apartment. And it was the property that we ended up closing in Richmond, towns at Chimborazo. It's right behind the Chimbo Mart. And I tried to buy that by myself. went into 10 different banks. They all told me the same thing. You don't have any experience. I said, what do you mean I don't have any experience? I got a license for engineering. I'm a project management professional. I got an MBA. I got an 800 credit score. Like, what are you talking about? You're like, you've never bought something of this size. And because you haven't, you don't have any experience. And I said, okay, so how do I get experience? They said, you got to sign a loan on a multifamily property. And so I went and started fixing and flipping houses. And lo and behold, another investor came up to one of my flip houses and said, hey, let me check out your finishes. Let's see what you guys are putting in, because we're getting ready to do one down the street. And during the course of that conversation, he mentioned, hey, we're going to buy another property and we're going to make a bid on this building. It was the same one that I looked at like 4 months earlier. I was like, oh man, please don't leave me out. He ignored me. He went and made the offer without me because he didn't need me. He already had experience. He had money. He had the deal and he had some knowledge, so he didn't need me. He went and talked to another one of my buddies and he said, that's the one Jerome was talking about. I'm not doing the deal unless Jerome's in the deal with us. And because that happened, I was able to get into my first deal as a joint venture and get that experience box checked. From there, I left and came back down to Greensboro where I went to college. And we've been doing transactions down here ever since.
That is awesome. So you haven't heard my corporate America story, but it actually is not completely dissimilar, because twice I was scaling up in corporate America and then laying off, and it sucks. Totally sucks. The first time I was working basically for Lucent Technologies, and we were opening factories all over the world, including China, which is in the news a lot now, as you know. So we went to China, we opened up a factory and opened up different factories in Mexico. And then right after Y2K, our factory was where Lowe's is on Laburnum right now. We had 2,200 employees and we closed and went down to 30 people. So that wasn't very fun. We were outsourcing our jobs. I didn't even know it. So then I took a job with a window and door company and I was general manager in Richmond and in the Raleigh-Durham area. And then same thing, it's like we're closing. So I laid every single person off in our two factories and I said, I can't do this anymore. That is it. So that's how I ended up in real estate as well, and left engineering behind also, which was a good move. I wish I'd done it younger like you. Well, I was a little younger back then. It was like 15 years ago, but still, you know what I mean? And your story at the Chimborazo market area, I love, because I remember working at 604 Chimborazo in about 2005, and that block was rough back then, but it is beautiful now.
It is.
I've got apartments on Chimborazo that I love having. And so that area is totally gentrified, and you're going to do great there, I'm sure, long term.
Yeah, I mean, that property is really cool because we were able to buy it where rents were around $695.
Yeah.
We're getting $11.95 there. So, yeah. I mean, just a tremendous value add opportunity for us. And it didn't go without its hiccups, but, we were able to make that transition. And, at the end of the day, you can't put people who are paying $700 for rent with people that pay $1,200 for rent. It just doesn't work. So
good point. Yeah, and transitioning those rents and adding that value is tricky. We'll come back to that in a minute. Now, all of our listeners may be wondering, like, how do I connect with Jerome? You can connect through the links below me if you want, or just go to myersmethods.com, M-Y-E-R-S methods.com. Jerome, you've also got your Mid-Atlantic Multifamily Conference coming up July 31st, August 2nd. You want to talk about that a little bit?
Yeah, so this one is a no pitch. If you've ever been to most real estate conferences, the whole game is to sell the program, right? They charge you a really low rate, offer you a ton of value, or what some people perceive to be a ton of value, and then they want to sell you on some mentoring program. Nobody that's talking has anything to sell except for me, and I'm not selling the course when we're there, right? It's an opportunity for people to come in and share from a genuine place of wanting to see other people be successful. Very similar to what you would see a deal maker. I got the opportunity to come in to my first event this year, and I was really amazed. I've seen all of the positive comments, and I know some of the past speakers and heard them share about how phenomenal the event was, but to actually be there for myself and see the camaraderie and all the folks sitting in the room, it was just amazing. And so it's our goal to cultivate something very similar to that. Won't be as nice as Jim's thing, but that's okay. We'll get there eventually. This is the first go around. So
Yeah, I'm really looking forward to it. And I'm glad you guys have rescheduled. I think your dates should be safe. We'll be past this pandemic. All the fear will be gone. We'll be able to hug each other again someday and have break bread and have lunch and all that good stuff.
yeah, that's the plan. I mean, I wish this thing was going quicker than what it is. I was hoping, everything would be back to normal by Easter, but it doesn't look like that's going to be the case.
So I think, unemployment's skyrocketing. I think it's up close to 10% or higher now. And none of us know, like, is this going to be like a sharp V down and a sharp V up, or is it going to have like a long extended trough in the middle, or is it going to be the Great Depression? It's going to be somewhere in between all that. But I do think like there will be, I'm hoping there's a little bit of a reset on cap rates, and I can buy some stuff that makes better sense now in the near future. Are you thinking that in your brain? Are you thinking about what's going to happen here?
It's hard for me to say. I think there are going to be some people who are in trouble, right? I think some people overpay for stuff and they're counting on rents going up in order for the deal to make sense. Some of the stuff that we teach prevent us from making some of those mistakes. Last night, I got into an interesting discussion where people were talking about, well, people are converting their Airbnbs to long-term rentals, and that's destroying the market. I'm a data guy, right? So I had to go find the data, and it looks like, Airbnbs are only 2% of the total housing stock, and about 1 in 10, 1 in 11 of those are actually vacant units. And so, that small percentage of units coming back online, I don't think causes a housing issue.
Not all of them are. I mean, we've got a few Airbnbs, and we've been pretty fortunate to get them filled with longer term extended stay people right now. I've got 30-day stay people moving in, so we're just gonna ride it out for a little while. So, and I love data too. And I was looking at some data today on what cities may be impacted the most because of the higher unemployment and stuff that we're going through. And I mean, it makes sense, but like Orlando, Las Vegas, people with a lot of hospitality workers in those areas may be hit a little bit harder than say, North Carolina or Virginia.
Yeah, I posted a map on my Instagram not too long ago, and it showed the states that were having the highest impact. And to your point, it seemed like everything that was tourism-based economy were the ones that were having a big impact. Virginia, North Carolina looked really solid in the grand scheme of things, comparatively speaking. So I feel good about the markets that we're in. And, going back to the cap rate question, I think cap rates are really whether it's directly correlated or not with interest rates. And as long as interest rates stay down, it allows you the cap rate to compress because you can buy more with the debt that you have. I mean, when you get into the math and the debt service coverage ratios and all the other things that the banks and investors check when they're going into a deal, you're able to make those work. And so if you can get some long-term debt locked in, fixed rate debt, I think it puts you in a great position to cash flow long-term. And then if you want to sell, if your debt's assumable, there's going to be people that are really excited to pick up 3 and 4% debt in the future.
That's all good points. I think the sellers that I think there's a group of sellers that will become more motivated, and they're not the professional operators like you.
Yeah. Mom and pop don't do well if they're not running it like a business.
And they own more apartments than people think.
Especially the ones that are under 75 doors.
Right.
And we've got a really specific target focus on, that workforce housing in the smaller apartments. There's probably 5-6 groups around the country that are targeting the things over 100 doors. And I just don't want to compete with those folks. I want to compete with the doctors, the attorneys, the lawyers, people who have put their whole retirement into a property. I want to compete and buy with those folks because not a whole lot of people can actually perform on a transaction. And we feel like we can, and we're building a community of people that can help us do that.
Great point. And I think say a doctor owns an apartment complex of 20 units or 40 units, whatever it is. And they had a poor property manager before the pandemic. A poor property manager will destroy a multifamily property, in my opinion. They will under rent it. They will have trouble turning them quick enough. They have a lot of vacancy and a lot of expense with evictions and stuff like that, people paying late rent. And then we hit the pandemic and unemployment goes up and people are talking about rent strikes and all this other crap going on. All of a sudden, the person that was sort of marginally operating, not happy with their results, and all of a sudden, like 30% of their apartment complex goes unemployed, and all of a sudden, they've got a poor property manager in the middle. I could see them being motivated and just saying, like, I am done. I'm calling Jerome so he can fix this mess.
And we will be waiting with open arms to take on those deals. One of the things that we were adamant about when people were saying they're sitting on the sideline waiting for a correction was that we buy, right? Build our track record and our experience so that when a situation comes up where there is a correction, that we are in position because we've got cash flow, we've got balance sheet, and we've got the systems and tools in place in order to execute against a business plan to make those businesses profitable again. And I think everybody who waited on the sideline but does not have the experience is going to have a really hard time getting traditional financing. They may be able to get some private money, but that goes back to what you can actually buy, right? On the cap rate standpoint, I can only pay X for it if my interest rate is 8, 9, 10% with the hard money versus what you can pay for it if it's 3, 4, 5.
So I think there'll be opportunities, and on the West Coast, I mean, people have been buying stuff at 3 cap. I think that could go up, but I think there'll be opportunities also for these mom and pop, like lawyers or doctors that own 20, 40 units to also get into some creative deal structuring and help the investors like us buy those apartments with a second note, for the down payment and things like that. So watch for price decreases, but I think it's also a good time for creative deal structuring along the way. So let's talk about what a broken apartment complex with fixable problems looks like in your mind.
So I guess at the highest level, we go in and we look for properties that have an operating expense ratio over 50%. And so, how much money do they collect? When you divide the expenses by that number, what's your percentage? If it's over 55%, then we go into the profit and loss statement and try to identify which things are out of balance. If maybe they're paying the utility bills. Okay, can the utility bills be billed back to the residents? Maybe they've got really high vacancy. Maybe it's under market rent and the property doesn't perform at the number that it is. Are you able to get more rent by renovating the units, or is the property manager, as you mentioned already, just poor and not marketing the property well and getting good qualified tenants in? And so, we go through the P&L, we look at the market and see how things are performing. And then from there, we go into a place of action, where we craft a business plan and then execute against that.
When I think about it, you saw the one that I looked at, you helped me. That thing had over 60% expenses. Like when I'm buying single family homes, that number is mind blowing. It's a big shift from single family to multifamily in that regard. So you're saying you will look for stuff with 50+% expenses, knowing that it can be fixed operationally, hopefully, that it's got a fixable problem.
Yeah, when those numbers get that high, you probably have a combination of things. Your expenses are too high and you haven't collected enough rent. Now, not collecting enough rent can be a couple of things, right? You can be under market rent. That's an issue. You can have too much vacancy. That's usually a more common issue than the other things. And so you got to balance the vacancy versus getting as much as you can from rent. We don't believe that an apartment should be fully leased. If you're at 100%, your rents aren't high enough. But if you buy it at the right number, you can probably go down to 70% of collection, sometimes even 65%, and still be able to pay all your bills, including your debt service. And so, we stress test things to make sure that we can sit in a comfortable place if we're impacted. We can't run a building if we're only at 50% collections, But, something north of that, we feel like we're in a really good place. And so, yeah, if all the utilities are included, it's an older building, and you're paying a property manager something above 8%, you're going to be up in that 60% range. And there's opportunity for you to be more efficient usually. But if we can't identify a specific problem to solve, then we're not interested in buying the property. We've got to know what the issue is when we go in. And, it's funny, as fix and flippers, as most of us have been at some point or another, you go in and you think you understand all the issues with the house, and then you open a wall and you find something you didn't. Apartments are no different, right? So you've got to have that problem that you're trying to fix specifically. But after you have that, you absolutely want to have some contingency, some bump in, or some fat in place, so that if something happens, you're still able to make it through the project. Because no different than a fix and flip. Once you get into the project, you have to finish. And so if you just have to feed the alligator because it's not laying any eggs as a goose yet, and until you get out of it. And there's a whole lot of people who, I'm okay with creative financing if you know what you're doing. But if you get into a deal with no money in and you don't have any money and something goes wrong, you're going to fail.
Don't you think right now is more than ever is it time for cash reserves?
Cash reserves are huge. And, we've had some properties where, we went down into the valley of death where, we had to write checks to pay debt because our vacancy was low, because we were renovating units and transitioning tenants and doing a bunch of other stuff. And now we're coming back out of that and looking to build cash reserves. But because we do this with partners, we've got guys that are sitting in really strong positions financially, and they're able to help us weather the storm as we go through the issues. But again, I can't emphasize this enough. Having capital is the difference between your project succeeding and failing when something shifts that you didn't plan for.
It's capital intensive. It really is. I agree. So you had a great LinkedIn post. Your posts in LinkedIn are outstanding, by the way. I like all of them. Everybody needs to follow you in LinkedIn. I'll put your link down below me. You guys need to check through to Jerome. But you had a great discussion on there regarding how much work, how long it takes, and how much effort it is to pull up the rents in a multifamily complex. Because we look at like the P&L before we buy something, we're like, man, those rents are at $750. They should be at $995. I can just snap my fingers and they're all at $1,000. Can you talk us through like your experience going through that? Like, what does it really take to do that?
I appreciate you giving me the opportunity to talk about that, and even remembering that I posted that on LinkedIn. A lot of people come from the single family space when they go into multis, and you can change the rent at your single family as soon as the lease expires, right? Yep. Here's the new rent, guys. You either do it or not. But you got to think about a multifamily. Let's just use a 20-unit property in particular. If you've got 20 leases all expiring at different months, some people moving out, some people continuing to stay. Let's say for that property in particular, we bought that property where rents were at $500 or $525, somewhere in that range. A new lease, one that's been renovated, is now going at $685 and probably will go up to $700 before it's all said and done this year. We're not going to take somebody who was paying $500 or $525 to $700 at the end of the year when their lease expires. Right. And if they choose to stay, we may be able to move their rent 5, 10, maybe even 15%, but they're only going to take so much of that before they get ready to move out. And the one thing you have to consider is it better to have somebody stay in there, pay you your $500 to $800 a month or whatever you're getting, or do you want them to move out so that you can spend somewhere between $4,000 and $6,000 or maybe even $8,000 to renovate that unit? Seems hardly likely that you want to make that capital outlay in order to get an extra $100 a month in rent. We can talk about the math behind it on why those types of things make sense. But just at the highest level, if you want to sit in cash and you want to have a cash flowing asset, it's probably better to just move that rent 40, 50, 60 bucks and allow that person to continue to occupy the unit without you renovating it. And so what we've done over the course of 18 months, maybe 20 months at this property, is we took those rents from $525 up to like $650. But it was an arduous process, right? We start moving things up, people wouldn't pay or they're partial pay, and that'll pull the average down. We thought we were going to come in the first year and only renovate 4 or 5 of those units. We ended up renovating 12 or 13. Mm-hmm. Now like 15. And so all of those units are getting the new rent premium, but the ones where we still have the legacy residents, those 3, 4, 5 units that are still there, we're glad to have those folks there because we're not paying out of pocket to renovate the unit. But they do drag down the average, right? We've moved them from 525 to 600 or 615, but we're still not getting up there in that 685 range where we feel like market rent is. And so, you've got competing principles. These are not islands like a single family home. And so when people go in and model, most models have, hey, what's the average rent for the year? People put in what's happening today, and then they say, hey, well, market rent is this, so we're just going to move it to that. And they're going to do that with what? Without doing any renovations, without changing leases, like without any negotiation. Like that's just not real in the real world. And so, we get excited about that. And again, I'm a data guy, and so how do we become better, right? You don't capture all of it in one fell swoop.
And the other consideration is like if you can raise those rents over a period of time, even 50% or 25% of them, it impacts the value of the property, which helps you refinance or someday sell because it impacts the value through your cap rate.
Yeah, I mean,
There's a lot of things to keep in mind.
Well, and that part is why the renovation actually makes sense, right? If you have the right cap rate, you can spend X amount of dollars and that changes the value of the property by a significant amount by having that extra income coming in and, subtracting out a percentage of that for expenses. We've been able to take that property from 840 when we bought it, and we're talking to brokers, and we expected to trade between 1.4 and 1.6 million dollars depending on what happens with the coronavirus and some of the other market factors. And so basically we've doubled the rent. But the great thing is for the guys that are in that deal, that made that bet with me, we brought $250,000, $300,000 to that deal, put permanent debt from the bank on it. And so now the gap, right, we've got a $600,000 loan or something like that after all our capital expenses, all of that equity, right, the $500,000 of equity, we're controlling with, $200,000-$300,000. And so that's the play for us is we get the real big bump on the backside. We haven't made much cash from a cash flow perspective, but we've repositioned the property. And we had somebody to pay the debt basically the whole way through, being the residents in the units that we weren't renovating. And so it's a great hybrid. We're taking all the skills, right? Wholesaling. I mailed the owner of this property. We did the construction, so we did a fix and flip. We executed the buy and hold strategy to pay our mortgage and the other expenses along the way. And now we get to exit and take advantage of what only I think you can do in a commercial property and take advantage of that cap rate.
Awesome. I love it all. So myersmethods.com, what's your vision with what you're doing on the teaching and mentoring side?
I've struggled with this. I've visited with a few different guru groups.
Me too.
People are getting taken advantage of.
I agree.
They're being told, hey, go hunt Moby Dick right out the back. Go take down a 100-unit building. Go take down a 150 or 200-unit building. And the reality of the situation is a very, very, very small percentage of people are successful at that. Our approach is very different. We want you to go take down something that's $500,000 to $1.5 million with a group of friends and family in a joint venture model instead of a syndication. And in doing that, you get some true experience. You get a win because you actually find a deal, right? If there's 10 200-unit buildings in your city right now, there's probably 120-unit buildings. And so you've got a broader net. You don't have people from all over the country chasing the same product that you're chasing. And they're on a percentage basis, you're probably in a position to make more money by executing the business plan successfully. And so we want to teach people how to do that. That's how we got started. And once they're able to do that, then they can step up and buy something else and buy something else. Michael Blank, which is one of the teachers, he talks about the law of the first deal. And in the law of the first deal, it basically says the first deal you do is the hardest one. And then every deal after that comes faster and easier than the first one. And so we want people to get through that first deal. And we think the way to get through the first deal is to buy one of these smaller properties, cut their teeth, make some adjustments. And just to give you an example, on that building in Churchill we bought, I was off on the estimate for the HVAC by about $2,000. There's 23 units there.
Right.
right? That number is big when you're multiplying. When it's single family budget, you mess up, hey, it's one thing, but you can get up into the hundreds of $1,000s really quickly. And telling people you don't know what you're doing or how you messed up doesn't work really well when there's a ton of people that you don't have a strong relationship with. And so there's a focus on relationships, and then there's also a focus on working on the smaller stuff. And to be honest with you, Jim, everybody that you talk to say the smaller projects are the harder projects. So do the harder projects first, and then when you step up to the other things, it becomes a lot more easier.
Okay, great. You've got a new Facebook group. How do our listeners find that?
Yeah, so we just launched last week. We launched a podcast, Myers Methods Presents Multifamily Missteps, and we've created a Facebook group to grow a community around that. And the whole purpose of that podcast is to bring operators on and give real life examples of the things that they've stumbled on while they've been working in the business. This isn't the fairy tale where everything works out the way it's supposed to. It's people who are experiencing loss of real money and real time, and just whatever shows up. There's just so many people operating in the space who are willing to share their seminars, right, so everybody doesn't have to go through the same thing. It doesn't make sense for Jim and I to make the same mistake. If I make the mistake, I want to keep Jim from making it.
Well, I've made a lot of them.
As a collective, but the collective genius of the group grows bigger as you share that information. And so we were able to do 8 interviews last week. I've got 15 this week. So here's worth of content in the next month or so. And people will just be able to pop in, meet other folks who are interested in multifamily. And that group is free. And then, if you want to engage with, the Myers Methods team on a deeper level, we've got a paid group for $29 a month where you can meet with people that own, people who have cash and are looking for deals, and people who are bringing deals in.
That is a deal. Hey, when this social distancing thing is over, we can grab lunch.
That'd be awesome.
All right. I look forward to doing that. I don't want to hold you up too much. You're doing a lot of interviews, and that was a lot of content and a lot of giving. So everyone go to myersmethods.com. Check out the Mid-Atlantic Multifamily, July 31st, August 2nd. Where would they go to register for that now?
We've got a Eventbrite page up, and then if you want to, it's a little bit cheaper if you go to myersmethods.com/con 2020. So MYERSMETHODS.com/CON 2020. Those tickets are a little bit cheaper, and that's just because you're coming direct to us.
All right, awesome. Great opportunity, everybody. Jerome, it has been a true pleasure to catch up with you today, and I wish you the best of luck as we go forward. Nobody knows the future. None of us have a crystal ball, but we just take our faith and go one day at a time, and we'll see what happens and where we're at when this whole mess is over. But I'm looking forward to seeing what the new opportunities are, and I know you are as well.
Thank you, Jim. I really appreciate the opportunity to share with your community.
All right, thanks to all of our great success listeners. You guys are all rock stars. Thanks for sharing content for the recent reviews we've been getting in iTunes, comments in YouTube, and social media. You guys are all rock stars. Thank you all very much. Get out there, be ready to go on that first 20-unit building, guys. I hope your wheels are turning and you're ready to take some action, and we'll see you guys all later.